Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Amanda Cruz of Voyage Investing. We're talking manufactured housing, aka mobile home parks, but this is a little bit of a different twist as we go through how Amanda got into it and why, and what she does across all of these parts of this asset class. What it stands for: affordable housing, decreasing supply, value add opportunities, and better returns. Let's do it right now. This is episode 345 of Zen and the Art of Real Estate Investing with my guest, Amanda Cruz. Amanda is the owner and founder of Voyage Investing, where they build and buy manufactured housing, aka mobile home parks. She's also the co-host of what I think is the longest running real estate investing podcast in the world, Best Ever CRE Show. Amanda, welcome to the show.
Hey, thanks, Jonathan. Thanks for having me. How's it going?
Oh, it's going very well. I'm glad we're getting in a nice morning run here to record. And I'm excited to talk mobile home parks and manufactured housing. But I know you didn't start there. Where did you start and why?
Oh, I started in corporate world, totally traditionally.
Yeah.
When we were ready to get into real estate and try to go beyond the W-2 world, we just started with a duplex. We put our own money into it. We had to pay 25% down, nothing very exciting. That was in 2018.
Yeah, you guys weren't house hacking. You were doing a straight out investment. What led to it though? Not. Bigger pockets, article, financial freedom. Where did it start?
All of it. I had been thinking about real estate investing for a while. Way back when I was in college, I rented a house with other girls, and I knew the owners of it had a daughter who'd been in college. They bought it, they rented it out to her and her friends, and then she graduated and they rented it to us. And, you know, I could at least run some basic numbers on how much we were paying. I knew how much the townhouses were in the area. So I was like, oh, there's some margin here. Maybe one day I'll buy real estate.
Yeah.
Fast forward several years later, I had done nothing with it, but I was ready to explore something outside of a corporate job forever. I started talking with other people. This one guy I used to work with, funny enough, owned mobile home parks, which is not common, and it definitely wasn't common back in 2017.
Yeah.
And he told me about bigger pockets and just started listening like everybody else does. Like, oh, wait, people do this. It's not crazy. People actually buy real estate and rent it out. And we did it. We just bought a duplex. It was on the market. It had just come listed. We'd been working with an agent who knew we wanted something like that.
Yeah.
We fixed it up, and, you know, we had all the scary things. There's mold on the floorboards, and we pushed past that. And the problems in real estate aren't hard to solve as long as there's a number that makes sense for them.
Yeah.
And so we just did it and started doing some burrs. And then we started doing individual mobile homes called Lonnie deals. You just buy an individual home in somebody else's. So many people say that, Jonathan. There was this guy, Lonnie Scruggs. He's from Virginia. He has passed away a while ago now. And he coined the term Lonnie deal, which is just buying an individual mobile home in somebody else's park.
Yeah.
And you buy it like you would anything else, right? You get a good deal because somebody needs to sell. And then you turn around and you carry the note for the end buyer who wants to live there. And those can make really, really good returns percentage-wise. Like 50, 60% returns. I mean, it is small dollar amounts, but it's an easy entry into doing real estate. So that's really that was really what got us into manufactured housing. And we just kind of never looked back from there and started buying parks.
Yeah, I love the Lonnie deal because I just did a land flipping show a couple shows ago, and whenever I do those, I'm like, that's such a low input. Like, if anyone can get into it. A Lonnie deal, basically, pretty much anybody can buy one of those. You could do just a very like $1,000 to $3,000 rehab on it, and then hold the note, and now you really do have not passive income, but you have rental income, and you barely put any money in, right?
Honestly, you don't even have to rehab. We wouldn't rehab them. We would just buy them and then we would sell them as is. Now, we might have in that case, I think our first one, we quite literally only had $3,000 in. We had the person we were buying from even carry that note for us at no interest. And then we sold and did.
Yeah.
Yeah.
That is really like a land flip, though.
It is, but here's why I like it better. Land flipping, especially in 2026, it is completely saturated with everybody on their computers with AI. It's dialed in.
Yeah.
No one's out there dialing in individual mobile homes this. So you have to go and find them locally. So it's a lot harder to get into. I think mentally it's harder to get into. No one's just sitting on their computers from California doing this. And so for an entryway to get into real estate, I do like those. You're not going to make a lot of money, but you're going to learn.
Yeah, but like you said, there's a percentage increase. And when I think of that, it's like, okay, well, if I keep going at this, my percentage increase will be more because my in value will be more. Or you can scale and just do more deals, but it's accessible.
100%. It's so accessible because you can get in with a few $1,000s. And there's honestly not that much real estate you can get in with only a few $1,000s unless, dude, I had this guy call me yesterday, a mobile home park we're selling. And it was so clear from the conversation, they just wanted a way to buy something with no money out of pocket. I'm like, look, guys, like, I get what you're doing. I get it, but this is not the right deal for you. Like, and so unless you're really just trying to do that, which is super challenging in 2026, going into one of these Lonnie deals is very approachable.
Yeah. Did you have to battle the stereotype of mobile homes at all when you got into it? Because I've had so many mobile home shows, and I think in the beginning everyone's like, oh, well, people just assume every mobile home's a trailer park until they see a nice manufactured housing, and they're like, oh, this is a mobile home? Are you kidding? It's not on wheels, or something like that.
It totally runs the gamut. I mean, in addition to mobile home parks, we buy individual pieces of land and put a brand new double wide manufactured home on it. I sell those for $300,000, right? Because it's a home, it's land, it's real estate. They're beautiful. They're 1,500 square feet. I've brought my dad in, I brought my father-in-law in and show them, and they're like, wait, this is a mobile home? I would buy it. I would live here. I would buy this. I'm like, yeah, it's very different than what you think. That being said, Jonathan, we have communities that are all age communities that are very affordable, where some of the houses trade in there for $5,000 or $10,000. So it completely runs the gamut. And I don't know that we really had a stereotype to get past. Our lenders at this point in time, people know mobile home parks can be great investments if you buy them right. So from the investor side, not as much. And from the buyer side, the tenant side, it's affordable housing. So there's not a shortage of demand there either. So we haven't really run into too many issues.
When you were saying the prices of kind of the lower end mobile home park, I was thinking of that as well. Like, this is truly an opportunity to provide affordable housing. It may not be what you thought of in your mind because there's, quote, affordable housing, and then there's affordable housing, government affordable housing. But this is truly the most affordable housing out there because it has the lowest cost for people to live there in terms of rent and buy price.
100%. And you're spot on. Affordable housing can mean different things to different people. I truly think when we put these $300,000 homes out there, that's also affordable housing because guess what? It's a brand new home and it's not $700,000 like the ones down the street. And then you have affordable housing like, hey, this is basically your last step or you're homeless. That is some of the all-age community mobile home parks. And that is also a great option for individuals who can come in and buy their own home. And let's say they're even paying for that on terms. Like, we finance the home to them plus their lot rent. They may be paying $600, $700, $800 a month. Like, where else are you going to live for that?
Yeah. And the terms are really important because this, what you're describing, even from your first deal of holding the note, this is very common for mobile home park investors. So you have your opportunity to flip mobile homes, trade them, build them, like you said. But holding the notes is a big part of the business as well, because a lot of those people wouldn't qualify for mortgages, or the price point's so low, no one's putting a mortgage on it. So it's really, that's a big part of the business, isn't it?
It can be, yeah. I mean, everyone wants a tenant-owned home community that's on city water and city sewer. Well, guess what? Do you want to pay a 5.5 cap for it or even lower?
Right.
Like, that's what you're going to get. It's so competitive. And so the opportunities in this space can be taking park-owned homes, converting them to tenant-owned homes. And yeah, for some of those, there's third-party chattel financing. So we'll put like 21st Mortgage or Triad. There are plenty of companies who will finance for the owners of the home, so we don't have to.
Oh,
But
that's
that's
nice.
more for like let's say $20,000 and up. New homes we bring in, $80,000 homes, those are perfect candidates for third-party financing. But these homes we acquire when we buy a park that might be worth 15, 20 grand, yeah, we tend to finance those because it's so easy to sell them. It's extra cash flow. We didn't really pay for the home, so it just makes sense.
Yeah. Have you found it interesting that I don't know what you thought of where you would find them in the beginning, but I've found over the years, just in talking to so many people, mobile home parks are everywhere. So people think like, oh no, I live in a nice area. There's not going to be one. Nope, there's one. There's literally one like in almost every town. And then in some towns, there's a lot. I mean, there's one in Malibu where they're $3 million. Like this is a widespread thing that I don't think people understand. And that means you can go from all the way to the bottom to the top, right?
Yeah, now I am not going to buy a Malibu mobile home park. I can only imagine how bad of an investment that would be. We don't buy the fancy retirement communities in Arizona and Florida.
Right,
That's
right.
honestly private equity companies at this point parking money. But you're right,
Agree.
they're everywhere. And I live in North Carolina. They're everywhere, especially if you go out of the city. In the counties, there's so many manufactured homes. It's funny, obviously, I look for this because this is our life, but I was just flying back into Raleigh 2 days ago, and from the airplane, I can see down. I'm just like, God, there are so many manufactured homes around here. Like, they're everywhere.
People on the plane are like, I wish this lady would shut up about all of the mobile home parks. Like, what is she doing? But I can see, like, from the top, you can really tell. And then you can see how big they are, what kind of setup they have. When you first started going past the Lonnie deals and wanted to get into something bigger, how did that come about?
We knew there was something to it. We could tell because we did a handful of those. So there was so much demand on the sell side. We knew we wanted to go bigger. You can scale Lonnie deals. There are people who do that, but it's kind of silly to me to really scale that. Like, how many can you actually buy? It's a lot of work. The margins are a couple $100 a month if you're bringing in a lender and then you're also selling. Like, I'm not going to bother with that. We started learning. We literally got a CD course. This was, I mean, I guess it was about 2019 or so. I mean, CDs were kind of already bygone, but we got a CD course and listened to all 18 CDs. At the time, I was going back and forth between Raleigh and I worked up at Capital One in Richmond for like a decade. So I was driving when I had to go up there and I would just listen to these CDs on how to own mobile home parks. And that's truly how we got started.
Yeah. And have you always looked locally just because it's accessible and easier to find? And then at some point, did you branch out or have you stayed North Carolina based?
We've bought in North Carolina, South Carolina, and Tennessee. Our
So close by.
closest park is 2.5 hours away.
Oh, okay.
Yeah, we don't own right in Raleigh. I sure wish we did. But even when we were getting started, I was like, oh, I can't afford these. Like the numbers just don't make sense. And I wish I would have bought all of them. But we have between 2.5 hours and 5 hours away.
On the parks that you own or operate, what type of operation are you walking into for people who don't understand how they work? Like, are you walking in and there's already someone who's running the park? Or are you bringing in someone to run the park? Because these are smaller. They're, and mobile home parks management can be a little bit tricky depending on kind of how upscale or downscale it is.
It depends on the park. So we've bought parks. Kind of the typical scenario is we buy from a woman, her husband had passed away, they had been running it together. and she's collecting rent in cash. So people are either bringing it to her house or she's going door to door. And so we come in and we put somebody in place to handle the day-to-day just on site.
Yeah.
Somebody needs something. You have a late notice that needs to be put on a door, whatever. And then we take the rent collections and move those electronic. So we don't have anybody going door to door collecting rent.
Yeah.
That's a typical case. Sometimes, like, we just bought a park last week where there was a manager in place, and we're going to roll with that. They seem to be doing fine. So we're going to try that out and hopefully keep that.
Yeah. So you'd kind of do a survey of what's they're doing, what's working, and then where are the levers that you can improve, which obviously are going to raise your overall value. What's the first thing that you look for that you think is like the biggest ROI when you're buying?
It's always rents.
Yeah,
it's always when rents are below market, right?
Especially
especially
as you described, it's like someone, either an older couple or someone whose spouse passed away. They're friends with everybody. They live there too. They're like, oh, whatever. The rents are fine. They own it, outright. It's not that big a deal to them.
100%. They may not live there, but they own it outright. They don't care. And most importantly, they're not putting the money back in to justify rent increases. They're just letting it roll. And I get that, right? That's what's made them money for the past 2 decades, and that's where they are. So they need fresh people to come in, infuse the capital, bring it back to what it should be. And that also requires rent increases. Now, depending on the type of owner you are, there are people in this business who will go in and very quickly raise rents. That is not what we do. And we try to differentiate ourselves with different owners who we want to buy from, that we're not going in and doubling rents overnight. It depends on your business plan and what you're doing, but we'll bring those to market over usually several years.
Yeah, and haven't you found that if you do it that way and you're building up the park and adding amenities and upgrading things, no one's really going to complain. They all know they were paying extremely low rent. So as long as you're giving value, they don't want to move. And it's not like you're kind of doing the self-storage, holding the gun to their head every 3 months saying, hey, we're going up $5. And you're like, it's just not worth moving. It's fair as long as you're providing something for what the rent increase will be.
I completely agree it's fair, and we do it staggered. That being said, do you know a group of tenants who's not going to complain? Like, we always get something.
That's a good point. Right? Yeah, it's almost, that's like very aspirational to say, hey, we bought 100 pads and we raised the rent. And everyone was like, thanks so much for raising the rent and, just increasing the plumbing output by 0.01%. We're so happy with you. Yeah, I understand.
Exactly.
Yeah.
But we're looking really at the top line as the driver of value, because honestly, on the bottom line, often we need to put in more money than they were paying. They may not have insurance. They're not keeping up the place. So there's hardly much you can do on the expense side. Usually your expenses go up, and it's really the revenue side where you can have a lever.
Are the mom and pop owners usually behind on collections? Not saying that like people aren't paying, but they're just more lax in terms of when they collect.
100%. I mean, you always have to ask, do you have the rent roll, which they obviously don't have, right? They are not going to send you from Rent Manager this nice report. So we have to work with them on what the rent roll even is. Right. And then you have to walk the park and just ask about each tenant, what's going on, because you'll find out, they're a couple months, they're a couple months behind here. But they always come back. We had one last month. We were under contract on one park. And in the handwritten rent roll, because that's what you get, handwritten rent roll.
Definitely, yeah.
It's a note that says, so-and-so is incarcerated, so hasn't paid in a while, but this happens often and she always comes back and pays. Like, okay.
That's old school. But that is interesting. I think it's important for people to note, if they're looking at it, there's rent roll, which is basically to me a pro forma, even though those are the rents they have, leases. It doesn't mean they're all being collected. If you take an asset class where rents are more likely to be behind, sure, D-class apartments, but yeah, I could see it happening in mobile home parks as well. A lot of times though, because everybody knows each other, so I can see it just being a little bit more relaxed. Like, I'll just give you 2 months next month. And someone's like, sure, whatever.
It's all on how the owner manages it.
Yeah, right,
if the owner's okay with that, then that's how the park is run. But we're going into a refi right now, and I just pulled, our delinquency, and we have 0 across 3 different parks that we're going to refi that none of them have been ever over 30 days late because that's how we run our parks. But that's the mom and pops we're buying from,
Yeah. What's the biggest objection for the people who are living there when you're coming in as new ownership? Is it just like kind of rate of change? They just assume you're some conglomerate or something?
Yeah, I think they're just nervous because most people don't like change.
Yeah.
And especially when you don't own the land underneath your home, that's
that's a good
nerve-wracking.
point.
And so they just want to understand who are you, what is being done. And to be honest with you, some of them just want a complaint. Like, I've been complaining about the dog that's always in my yard for the past 3 years and so-and-so didn't ever care. What are you going to do about it, kind of thing? And so, you just have to kind of take it as it comes and explain who you are, what the new processes are, and that's it.
Yeah. So if somebody's listening to this and they're like, that sounds pretty interesting to me, where's the best place for somebody to get started right now? Just wherever they live. Say, it doesn't matter where they live, but in their area, how should they get started in terms, like, should they try to find a Lonnie deal or should they drive through the parks? I think the cool thing about mobile home parks is they're rarely gated. So if you just want to look at a few, you can just drive through and kind of see what they look like.
If you have never done real estate and you're looking to get started, Lonnie deals are a great option.
Yeah.
Especially if you don't have that much money. If you have money, you're experienced in real estate, start looking at parks. All you have to do is quite literally, just like you would with any other type of real estate, and you just go see who owns it. And you look up the information and figure out their phone number like we do for any other type of property. That's how we get back to the owners. So that's all you have to do is just start calling them.
Yeah. And because mobile home parks are generally less e-friendly than other things, kind of similar to older school self-storage, a lot of times you go and there's a contact number right there. I mean, you don't have to reinvent the wheel. If you're driving by, like I go in upstate New York all the time, I drive by every self-storage, like it's like Brad's Storage, call me on my cell. And okay, that's how you find deals.
I will say, it's a competitive market. It is not 2015 anymore in mobile home parks.
It's changing. Yeah, it really
is. It's very competitive. And odds are that you start looking at the ones around you and you're like, oh, okay, well, that's owned by so-and-so. And you start digging in. You're like, oh, they own 150 parks. Oh, they own 100. Okay, I'm not buying from these guys. That's not. So, yeah, dig when you get the owner, make sure, do some Googling on that owner and see if they're actually part of a big company that's buying mobile home parks. But maybe you found a mom and pop.
Yeah, it's interesting, though. Based on a few of your responses, I think I'm a little behind the times in how I think of the acquisition because there is a lot of private equity into it because once it's running, it can be a well-oiled machine if you have proper management and you know what you're doing. So I think I need to take a little upgrade too on this.
Well, it's interesting, right? If we think of where we are in the world, we're in 2026 and multifamily, it was the darling of passive investors, of real estate investors. The world of syndications really rose over the past 10 years and everybody and their mother wanted to be a cowboy and go buy $100 million of multifamily. Well, I'm sure your listeners are aware that has not gone well for many investors and multifamily has crashed 30-40%. And a lot of investors, especially passive ones, have lost all of their money. Why? Because multifamily was mostly funded on 2-year bridge debt that all came due. In mobile home parks, that's not the case. A lot of our parks are not on bridge debt. So mobile home parks have not had the same reckoning that multifamily had. They've remained incredibly competitive. We don't take on bridge debt at all.
Yeah.
And it's also not common in the asset class. So you've had a lot of investors that have heard mobile home parks, they cash flow like crazy. They're cash cows. You can just buy them from mom and pops. No, we spend a lot of time calling and following up with individuals in the mobile home park space. But a lot of investors have jumped ship from multifamily in particular, thinking they can get better yields in mobile home parks, which is only true if you buy right.
Yeah.
Hey, it's Jonathan. I hope you're enjoying this episode with Amanda Cruz. We're talking about an interesting asset class here with manufactured housing, mobile home parks, and if you have interesting assets in your portfolio, commercial, investment, residential, these things that you're earning income on, one thing that you can do is cost segregation. It can give you a big bump on your taxes next year, or you can hold it for a further year into the future. If you want to check that out, talk to my guy, Sean Graham at Maven Cost Seg. You can use my link at mavencostseg.com/Greene. And Greene has an E at the end. Let's get back to Amanda.
I think you really need to understand the operator for mobile home parks as well. It's the same in multifamily. I mean, any type of syndication, obviously you guys on Best Ever do a lot of syndication shows. I've done a lot of syndication shows. It's part of the business, but it's really like, how well does the operator know the asset class? I was just saying to someone, I was on a podcast the other day, they were asking me about my passive investments. And I said, I would invest in X, like I would invest in mobile home parks, but I wouldn't invest in mobile home parks if a company had done 10 multifamilies, full cycle. And now they want to try mobile home parks. And that's not the place that I'm going. Do you agree with that in terms of just operators in general?
100%. That is where I'm finding the most people willing to overpay because they're thinking they're getting a great deal because the yields are better on paper
right.
than what they would see in multifamily, but they're massively overpaying for these parks. They're buying infill communities where there are a lot of vacancy and you have to go find homes and bring them in, which you have to know how to do that. And somebody who's only run multifamily, who's not in the mobile home park space, does not know how to do that.
Yeah.
And they're definitely overestimating what they can do with the communities.
Yeah, and I think you, as an LP, you have to be more creative in the questions that you're asking so you don't miss out on that. But I don't know about you, but I found that there are a lot of people who have invested in syndications and lost outside of market dynamics and bridge debt, like you said. They didn't really understand the actual asset class and what the operator knew about it. So it was kind of, I call it user error all the time, like someone who would invest in a mobile home syndication and they missed out on that. And it's maybe it's just a longer return than they thought, but they just didn't read everything because it's a lot to read and they didn't want to process it. And like you said, they saw a TikTok that said, go mobile home park. So they did it.
It's very interesting. For a long time, the who to invest with was, you've done this asset class for 5 full cycle deals
right.
and you're an expert in multifamily. But honestly, those individuals, a lot of them are ones who have lost a lot of investor capital in the past few years. And so it's more than just picking an operator with a track record, because it is important that you understand your asset class that you're in, but you also have to understand the dynamics of the overall market cycles and where we are in order to pick the right investments as well.
Yeah. Is there something when you're looking at a park to buy for yourself or, with investors, are you looking at the metrics or the uptick differently? Obviously you want to raise the rents. Are there other things there like that would be secondary in terms of like, cause in my head, and again, I might be a little bit off, but I think the CapEx comes a lot under the ground in mobile home parks, plumbing, electricity, things that maybe a novice investor just wouldn't see. Hey, everything looks great, but they don't know that the infrastructure for the park is what's going to cost them money over the years.
Oh, 100%. So you're never going to want to buy a wastewater treatment plant. Absolutely just don't buy those. And that's like a lagoon. It's a privately owned lake, basically, that treats sewage. Don't ever buy those. The risk is too high of a gigantic capital infusion coming.
Yeah.
But even like, we own hundreds of septic systems. We're very comfortable with that. We also go in and pump them and inspect them before we buy a park. You want to be looking at the water lines. Like, are they made of PVC? Are they made of something different? How old are they?
Clay,
right?
Have fun with that.
Yeah, Ray, good luck. Good luck. You may want to walk away from that. And so you really have to understand the infrastructure, because that's what makes it more valuable than farmland.
Yeah.
The ability to have utilities. Now, you can also add revenue through like utility billbacks, or we've taken a park that had a well and run county water lines through it. And then the county owns those water lines, and now it's direct bill water. You can add value that way as well, or, reduce expenses in that way. But you have to understand, like, I wouldn't have bought that park if we couldn't have run those water lines because I don't like wells.
Yeah. Is there an amount of pads or opportunities inside a park that is kind of more accessible to others? Like, where are the big people buying in at, and where are they not? Because in multifamily, it's usually like 100, or maybe like 60. Mom and pops can still have 50 units, but the big companies and hedge funds are all buying 100 and up with management in place. Is there a number like that for mobile home parks?
100 is the same. The private equity money is in 100.
Yeah.
But you also have, like, for instance, we buy 20 to like 60 is our sweet spot. We like to buy in the same area where we have other parks, because then you have a portfolio when you go to exit. And so we have different areas where we have over 100 spaces in that market,
Right.
but we bought them one at a time instead of going in and buying 150 spaces at once.
When you're clustering like that, does it help you with rents to have other parks? Because in my head, if I'm buying, a bunch of multifamilies and I have 5, or if I'm just doing burrs in a neighborhood, I can kind of play off of my own comps that way. Does that work as well with rentals and even sale prices for you on those?
The comps are what they are. So basically, our lot rents are driven by outside forces more than anything. Like, what can you rent an apartment for example? So we want to be about half of a studio or a third of a 3-bedroom apartment rent for lot rent. And so, sure, maybe if you owned all the mobile home parks in one market, you might be able to force that a little bit more, but it's really more outside dynamics than anything. Now, it does help with comps when you sell off homes, especially with that third-party financing. We can point to other homes in our park and say, oh, these were 30 grand a piece, so clearly this one should be too. But mostly lot rents are outside dynamics.
Yeah, that's interesting. I was thinking of the last part that you just said, but I'm interested to know that it doesn't work as much for the rents. But yeah, on the sales, it's just nice to have other ones like, hey, that park operates just like this, so that sale price should match this. You can just kind of help yourself. And then, of course, when you're buying, you already know the valuation because if you have a park in somewhere. Let's say just Wake Forest, I don't know, and they know that's where you're around that area. And then you're buying a second one, you kind of have good metrics for the area already built into the one that you own. So you're already kind of ahead of the curve for whoever you might be buying against in that one. Do you agree with that?
It's helpful to know the area for sure, because there's paper, like what does a market look like on paper? And then there's actually operating in a market. I mean, for me, the number one thing is population growth. Like, buying in markets where population's declining is just, we have one park in an area where population's declining. It is 10 times harder than any other park we own. And I would never buy in an area like that again.
Yeah.
Right. A lot of people now, that's one thing that multifamily investors coming into mobile home parks are missing, is the market is, everyone thinks, oh, it's affordable housing, there's demand everywhere. That is true. It doesn't mean your business plan isn't going to be 10 times harder if you buy in a harder market. Now, the market dynamics between, let's say, 2 markets we own in, like Wilkesboro, North Carolina, and like the Tri-Cities of Tennessee, we own in both of those. They're not that different, poverty-wise, income-wise, but we know from being in the markets that Eastern Tennessee, for us, dude, we can sell homes like nothing. Like, it's so easy for us to sell homes. So we really like that market. And we know that from being there, from marketing homes, from renting them out. Like, we just know the market a lot better. It also helps when you start getting more traction in a market, then the planners, that helps, which you wouldn't put the time into if you only had one park in one area.
Yeah. Can you explain for the listeners what the options are when you're buying a park? Because I know you can be renting, selling the pads. You can actually buy the units. There's so many different things that you can do in different ways inside parks. I don't know if you can do them all inside one park at the same time, but give us a little breakdown of what all you can do with the assets, because I think it's a lot more than people would think.
Yeah, and you can mix all of these if you want, but there's tenant-owned, that's what everybody wants. Tenant-owned, which means you own the land, you own the dirt, and people own their own homes, and they pay you lot rent to connect their homes to your infrastructure and rent it out. It's almost no turnover. It's way less intensive from a management perspective. So as you can imagine, it's more desirable. Now, what does that practically mean? It costs more money.
Yeah.
So
Yeah.
it's lower cap rates.
Yeah.
Then you can also have park-owned homes, which means you own the home in addition to the dirt underneath it, and you're renting it out just like a standard rental. Then let's say you buy a park where you have park-owned homes, but you don't want them. You can sell them, and that can look like we were talking about earlier, selling them on terms. So I'm doing rent to own or seller carry on these homes as I'm trying to get them off of my books. You'll see lots of parks that are in flux, where they have a bunch of tenant-owned homes and then a bunch of rent-to-owns. That means they came in and implemented their business plan to get those park-owned homes off their books, and they're in the couple-year time span where that happens. And then you can even have RV spots within mobile home parks. To me, I don't like a park like that because I don't buy RV parks. And to me, those should be separate assets. It's either hospitality or it's affordable housing. I don't think it should be both.
Yeah.
And oftentimes when I see parks that say, oh, we also have RV spaces, what that means is the space is so tiny, you can never infill it with a mobile home. So we're calling it an RV lot.
Yeah.
You can do all of those within a park. And honestly, Jonathan, you said it sounds complicated, but you often see parks that are a mix.
Interesting. Yeah, I mean, to me, I just like stuff that again, if I want to be passive, I want someone else managing it. But if there's more levers to pull, I just think it gives you options. Like if you need to do a capital improvement, you can sell a couple. There's just different things that you can do to help, adjust the income how you want it or what you want for future revenue.
Yeah, I think for us, it's more about what is the business plan. And it's typically moving to an all tenant-owned home scenario. So yes, you do get pops of cash as you sell those homes off, but more importantly, that makes the community stable, more hands-off, and more attractive for a future buyer or for a refinance. If you are looking at a mobile home park as an active investor, just know it is a lot of work. It's way more work than industrial, than a single-family home.
Oh, yeah.
If you're not trying to do a lot of work and you're thinking, oh, real estate's going to be my passive income play, absolutely do not go buy a mobile home park yourself. Only passively invest if you're looking to be hands-off.
Yeah. I've talked a lot about this. I want to get your take. Again, on your show, you talk to so many people in commercial and with syndications. I really think that this kind of new high income earner who is choosing not to buy a home, I think they should be looking to invest passively first instead of trying to do a flip or a burr like, you did, or like I'm doing flips when I was a kid. Do you think this is an option for people like I do? As long as they do the education, like could you see a first-time investor, instead of buying a duplex, investing in a mobile home park passively and enjoying it?
Yeah, 100%. We have people who come and invest with us. We do, honestly, a lot more private lenders. We have people who come and lend to us, which is even lower risk, right?
Yeah.
Because then you're not actually dependent on the business plan going well. You have a set return that you're getting.
That's nice.
And so I have a lot of individuals like that are like, hey, I know real estate is good, or I want to diversify. I have everything in the stock market, but I don't have the time. I have a full-time job. I have a family. And yeah, I think that can be a really good fit. That being said, just like anything, you don't want to just blindly go and find somebody on the internet that says they're syndicating and invest with them, because if there's anything you need to look into, it's what has happened in multifamily over the past couple of years, because a heck of a lot of people lost a lot of money investing in multifamily, and you don't want to be one of those passive investors. So you have to do research no matter what it is. But if you truly do want to be passive, then owning real estate is absolutely not passive.
I agree so much. I always say it. Being an LP has proven to me to really be passive. I can't do anything. My hands are tied. And that's why I personally like it. I can just see exactly what you said. If you do not go try to be an active investor in a mobile home park while you have a job and a family, your family will hate you and your job will fire you because you're going to be spending all your time there.
Unless your goal is to leave your job to go be a real estate investor, then go. Take the headache, feet in the fire, go do it. But if that's not your end goal, then owning a mobile home park actively probably doesn't make sense for you. There are
and you're
just
right.
way better options. Like go buy something that's triple net, or like go buy a piece of industrial. Like why are you going to go buy a mobile home park with so many moving pieces?
Well, I mean, for some people, it's because social media is so aggressive now. They see this, pitch on a very 1 minute thing that shows a very high, IRR, and it's attractive to people. But as somebody said something, I can't remember who said it, but I keep repeating it. Someone said, you're never going to see a pro forma for a syndication that is like terrible. That's not how you get it. No, we're going to get a 6% IRR. You want to invest?
Right.
They all look awesome in the beginning.
But you know what is interesting? And I'll tell you how much the mobile home park market has evolved in exactly what I'm about to tell you. For the second time in the past few months, I've seen, hey, we're about to raise capital for these great communities. We expect to have a 12.5% IRR for a 10-year hold. Like,
wow.
That's where we are in mobile home parks. Yeah. They're that competitive. So yeah, if you think you're just going to go and find one because, you drove by one and happened to call, it's very unlikely that you're going to strike the deal of a lifetime. But if you think about where we are in real estate, it's 2026. Deals are harder to come by. Like great returns are harder to come by. So you want to be positioning yourself with somebody who really knows what they're doing and is still succeeding. And also make sure you ask about current deals. There are so many, if you're looking to passively invest, there are so many operators in deals that are falling flat right now that they haven't returned capital. They're probably not going to. They stopped distributions. They might be doing a cash call, but that's not on their website.
Yeah.
Because
no, of course not.
Yeah. So be very careful about current deals as well as, a track record you're looking at.
Yeah, I mean, sometimes they're raising something that they're calling a pref, and it's really just to fix something else. And, I think a novice would not know that at all.
No, it looks great because then you're supposed to get 16% returns.
Yeah, exactly.
But wait, hold on. 16% returns in 2026 are pretty amazing. How am I getting this? Oh, it's because it's rescue capital and the deal's actually failing.
Yeah. You made a good point before, though. I can see people to understand what the market dynamics are. You couldn't listen to the CD if they were talking about terms that you did while you were driving back and forth and now assume that it works now. Like I always say, if you read the book on flipping houses by Jay Scott and there's numbers in there, that doesn't mean it applies to your market. Or it applies to 2026 because costs are way up, houses cost more. You have to really understand. And people, even with BRRRRs, they read the BRRRR book and then they're like, hey, it's 2025. I'm just going to do a BRRRR. And we're all like, you can't. The numbers don't number anymore, right? This is all part of the equation in each asset class to make sure that you're doing something that's actually going to be a smart investment.
I completely agree with the numbers side. Just kind of let those come in your ear and leave your other ear. But the strategies still apply.
Yeah,
There's the book that I read, it's called Deals on Wheels by Lonnie Scruggs. I don't even know if it's made anymore.
Yeah.
But when I was reading that to learn about Lonnie deals, they were talking about buying homes for $2,000 and selling them for $6,000. And
right. Use the framework, not the numbers.
The framework is still solid, still solid. But even BRRRRs, funny enough, Jonathan, I read the BRRRR book probably back in 2018 when we were buying stuff.
Yeah.
And I kept thinking I was the idiot because I was like, okay, great. I'm going to find this. I'm going to fix it up. And then I refinance and, well, crap, why doesn't it cash
That's
flow?
not that good. Yeah.
Oh, wait, in Raleigh, the numbers are a little different than wherever in the Midwest this guy, was when he wrote this book.
What do you think is the best resource for someone who wants to just start their kind of education in mobile homes right now?
In mobile homes or mobile home parks?
Mobile home parks, yeah. I mean, if they're thinking hey, I'm interested, this show sounds good, I'm not ready to invest now, but I want to start to learn more the right way so I don't, hire a guru for $75,000 to sell me a $10,000 pad somewhere.
It's interesting because most of the information out there is from people who have masterminds that want you to go join their mastermind to buy a park. I mean, I write blog posts and stuff on our website, which is voyageinvesting.com, which is about how mobile home parks work, how they make money, our strategy. You can certainly check that out. They're free. There are some other, bigger investor groups who have information on why they're good investments. Just make sure they're easy to find. Just make sure you understand the lens that you're reading it through. but it can be really good information on how they work, how you make money with them, buying them right, track record, all that good stuff.
Yeah, because it's just not an industry where there's like books that everybody knows about. And as you said, with almost all asset classes, whenever you see something that's big, there's a pitch to get into a mastermind. And look, those things work. If you're committed, even the ones that have a bad reputation, if you're committed to doing the work and working with other people, you're probably going to do well in all of these masterminds, no matter how much you pay. It's just about doing the work. But not everybody wants to sign up for, a $25,000 class to teach them what they may be able to learn slowly over a few years by reading unbiased blog posts.
Yeah, and it depends if you want to be active or passive as well. Like if you want to be active, you can there's plenty of places to go learn how to buy parks. But obviously, when we were learning, there was a podcast by Kevin Bupp back in the day of Sunrise Capital Investors before it got really, really huge. His podcast is probably still out there, and it's specific to mobile home park investing. He has another one that's just investing in general, but he had an old one he doesn't do anymore. That was an insanely helpful podcast because he used to interview operators.
Yeah.
Every episode. And we learned from that one a ton. So you can go dig that one back up too if you're looking for active investing. And of course, it's old now. The numbers may not be relevant, but the issues you're going to run into, the acquisition side, all of that is definitely still relevant.
Yeah, I think that's good advice on both. And with the books, like we were saying, it's like you're just looking for a framework on how it's going to work. So you're not procedurally like out of touch if someone starts talking about a deal to you. That's how I felt like when I read Hands Off Investor by Brian Burke. I was like, oh, okay, syndications make sense to me now. As an LP, I know what to look for because again, to invest as a passive investor in any of these deals like we're talking about, you're not looking at just one sheet. There's a lot that goes into it. So you do need a little prep work. As you were saying before, due diligence applies to being a passive investor. It's not like you're passive and your due diligence is passive. That's where you're going to do all the work. You just don't have to do anything after you get in.
100%. Like, it's funny, they say passive investing, but nothing is truly passive. Honestly, even unless you're just parking money in an index fund, like you want to do work. You want to make sure your money's in the right spots. And that absolutely applies to passively investing in real estate too.
Yeah. And I would say that even if you are a passive investor, you don't have to be passive. I mean, you don't have to be annoying, but like for me in my passive investments, the monthlies, I read every single word of everything. I feel like I'm learning about multifamily in my case by just reading what happens. So if I ever wanted to be a GP or to do something, like I'm getting like a mini masterclass, based on my investment, and you get to see what's going on. I think it'd be really cool to see that for mobile home parks and see what the turnover is, the change, how rents have gone up. If you just do that once a month to read every email, you're going to be way better off, and you'll feel better about your investment.
Yeah, good for you. Number one, if you are looking at somebody to passively invest with, ask for the latest update that they sent to their investors, right? Because it should have been last month. Or depending on,
wait, let me see. Hold on.
Got to dig that up somewhere. Like
from January. Huh, that's interesting. Yeah. That's a great point though. Yeah. Send me the last one. Yeah.
Yeah, you can do that. And good for you for reading them too. Like I can tell from my side because we send ours out monthly, and we had one individual, he wanted to invest on something else, and he said, "You're my go-to operator on mobile home parks, blah, blah, blah." Come to find out, I'm looking in our active campaign. He had unsubscribed from our updates a month after we bought the one park he's in. So he actually hasn't gotten a single update. Funny. I'm like, how are you wanting to reinvest when you haven't seen, okay, I'm going to add you back and make sure you actually stay on these.
Yeah. Oh, that's funny. The unsubscribe. I thought you were going to say his read rate was, 0 out of 14. No, but full unsubscribe.
I'm sure we see that too. He didn't mean to. He's like, I didn't unsubscribe.
Yeah.
Okay, well, you're the only one that unsubscribed out of anybody in here. So I'll just add you back. We're good.
Right. No problem. But yeah, just stay on the mailing list if you want to be in. I just find it helpful. I feel like if you can just learn along the way about the asset class that you chose to invest in. If not, it just seems, it's not hard to read one email a month. I wouldn't think so.
Yeah, you'd be surprised how many people read absolutely zero.
I know. I know. But I feel like those people are also ones who may miss when there's a hiccup in the middle. Like if it's not going well, it's coming out in one of those emails. If there's an issue, you might find out about it 8 months before, so you can prepare. If for some unforeseen reason there might be a capital call, you would know about it 8 months before if they disclose just a little bit. If you're just keeping up kind of every month on it.
Yeah, 100%. And Jonathan, I don't know if you've had to deal with capital calls probably since you're in multifamily.
I haven't.
Oh my God.
Yeah, I'm doing well.
Good for you.
Well,
I had one because I have a passive investment in multifamily, and I got the latest. So there's a capital call.
Yeah.
They used to have webinars, right? When capital calls kind of first started, people would have webinars and explain.
Yeah.
This was a one pager that was basically like, here's the money you owe. Pay it by this date or you're diluted. Thank you. That is it. I'm like, God, that explains a lot in like where we are with.
Yeah. It's not going well for them.
Right now.
And that means it's not going well for us as the investor. But no, yeah, so far I've been fortunate. I focus but it's a good thing though for you to say that, because we both obviously have experience, focus hard on the operator and on the asset, but there's still risk involved in passive investing as well. Real estate, I personally don't find it risky because I've been in it for so long. But for somebody new, it carries the same amount of risk, and risk could be dependent on your own due diligence, asset class, operator. There's a lot of things that could go wrong.
There are, and it's funny, everyone said risk-adjusted returns, and nobody cared about what that actually meant until a lot of deals started falling
Adjustments,
apart.
Yeah.
It's like, oh crap, if I'm doing a deal and I'm going to get an 18% IRR, but that requires the business plan to go well and interest rates to not skyrocket and not to have a 2-year bridge loan versus like on the private lending side where it's like, okay, 10% return. I don't get a piece of the upside, but I get that 10% return and it's a guaranteed return. Those are very different risk appetites as well. And a lot of people when like 2020, 2021, it's like, oh, obviously the 18% deal is going to be better than the 10% deal. It's like, well, not if you lose your money in the 18% deal. Well, then it's not. And so there's a really, the risk part of risk-adjusted returns is critical.
Yeah, one of my GP syndicator friends was telling me someone got on a call with them and said, like, but this other person promised a 32% IRR. It's like, just burn your money. Just burn it up. I'm going to go with them. Okay, good luck. No problem.
Okay.
Awesome. Is the best place for people to find you and get information about your investments at voyageinvesting.com?
Yep, exactly.
Yeah, and I went on the portfolio. I think it's cool to look through the portfolio of what you guys have, because you have some Lonnie deals on there as well.
Do I? I don't know that I have Lonnie deals, but I have builds.
There's some single builds.
Our builds that we do. Yeah.
Yeah. Not going super old school with the first one. Oh, yeah. How much did you pay for your first Lonnie? Oh, you didn't. You did double terms both ways, right?
I think we put down a couple $1,000. Yeah. It was not a lot, but at that time we were also buying homes for $6,000.
Yeah. Those days. Well, they come with their own headaches as well.
Oh, honestly, those are still available in mobile homes.
Yeah. Yeah. See, there you go. Low bar to entry in a good way.
For sure.
Yeah. Awesome. Well, it's been a pleasure. Thanks so much for coming on the show.
Awesome, Jonathan. Thanks for having me.
Yeah. All right. That was Amanda Cruz. You can find her at voyageinvesting.com, and you can find her and my guy, Ash Patel, on the Best Ever CRE podcast as well. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 346 of Zen and the Art of Real Estate Investing. And it's not a who, it's a solo show with me again. This time I'm going into my bag. We're coming up with the 10 best books for real estate investors. I've obviously read them all. I'm going to tell you why I like each one. This will be a great episode. Maybe even you're fully experienced and these are books that you've missed. It's going to go across asset classes, everything. See you next episode when we talk books, one of my favorite things. See you then.